I'm an engineer by training, so when we go through things, you may see more of the engineering flavor in what we do. But I've been developing and building companies over the past 30 years. So I've come to know a lot about organizations and organizational growth, but I specialize in the climate finance sector. Let me tell you a tiny bit about ECO. We've been operating for 24 years, and we specialize in supporting and guiding our clients to achieve low carbon, climate resilient development. We do this through catalyzing systemic change. So we're going to be talking a lot about the systemic change that this particular project has brought about. So thanks to all of you that gave me the comments, and thanks Keisha, thank you Priscilla for letting me know that the sound is going well now. So please do introduce yourself in the chat. Please do ask questions in the chat as we go. And I will also share a number of slides and things like that along the way. So I'll right now just share my screen to show a little outline of what we are going to do. So on this slide, you can see the projects that I put forward to discuss, to debate today. We had a very quick surge from one of the projects, the Klima Ventures one in Pakistan, and that was then soon overtaken by votes for the Burundian project. And finally, the Acumen project came forward as the ultimate winner in the what shall Grant discuss in this session project. So that is the project that we've selected. And I thought the best way of getting that initial introduction of the project was to turn to the GCF. And I have a little clip from the board meeting where the head of the private sector facility, Kavita Singha, introduces that project. So let's jump straight on to that.
Thank you, Co-Chair. It's my pleasure to introduce for the board's consideration FP252 Acumen Resilient Agriculture Fund 2, submitted by Acumen Fund. Smallholder farmers in Africa are increasingly vulnerable to climate change, facing rising temperature, droughts, and shifting rainfall patterns that threaten their livelihoods and food security. The smallholders cultivate 80% of Africa's farmland and are already facing impacts of climate change. In addition, they encounter various challenges, including poor market access and limited inputs, which reduce agriculture productivity, crop yields, and income, further limiting their adaptive capacity to climate change. To tackle these pressing issues, the program aims to enhance the climate resilience of smallholder farmers and agriculture value chain, ultimately promoting increased productivity and food security in the host countries. It will invest in venture, early growth stage companies that offer bundled adaptation solutions tailored for smallholder farmers. Additionally, the Technical Assistance Facility will support investee companies and smallholder farmers in enhancing climate resilience, integrating gender considerations, measuring impact, and advancing business development. The program aligns well with USP2 priorities by providing early-stage capital for innovative climate solutions, business models, and technologies to early-stage ventures and MSMEs, to enable smallholder farmers to adopt climate-resilient agriculture practices and access adaptation funding. GCF's $30 million equity contribution will be matched by $90 million equity co-financing towards a $120 million fund to support approximately 20 startups and ventures after the due diligence process. GCF will also provide $4 million in non-reimbursable grants to a grant-funded $12 million technical assistance facility. The program is expected to reach 4 million smallholder farmers and 19.85 million lives over its 10 to 12-year fund term. Thank you, Co-Chair.
Right, so that was an introduction from the head of the private sector facility introducing this project at the board meeting. It's a good time to say that I have no affiliation with the Green Climate Fund. my company does work for the Green Climate Fund and for many other clients. But what I say has got nothing to do with the opinion of the Green Climate Fund or Acumen or any of the project people involved in the project. It's just my take, my views on that project and how it goes about achieving change and delivering that sustainable transformation. So please don't take my word for it. Have a look yourself. Check what I'm saying. Is this the right thing? Is this the sort of view that you get from looking at the document? But hopefully it's going to be an interesting and useful discussion around that. Please do ask questions as we go, because I'll respond as quick as I can to those. So if you have comments or questions, put them in the chat, in the comments section on LinkedIn, and I will do my best to respond to them as we go. Now, here are the topics that I would like to talk about. Just going to share my screen once more, and the intention here is to dig into primarily what will the project do. Sorry, my screen share is not showing. Okay, so what will the project do? How is the project structured? So I'm really focusing in on those two elements of the of this project. And while we do that, I'm going to talk about a number of issues that have been raised in the board meeting. These are issues around consultations and engagement, about protections for the smallholder farmers that are involved in this project, a little bit about transparency and elements of transparency, and also about additionality of the project. There was one of the board members that repeatedly asked, is this really a climate project? Is this a climate adaptation project? So that's part of what I'm going to cover while we dig into what the project will actually do. So this is the theory of change. Let me just get rid of this text over the top. This is the theory of change of the project. It comes straight from the project proposal. I can give you a quick look at the proposal here. Whoops, daisy, didn't jump to the right one. Here we go. So we will spend some time digging into the proposal itself. It's a public document that you can find online on the website of the GCF. And we will talk about how this particular project achieves the results that it's going to achieve. Now, I find the theory of change for GCF projects a little bit complicated, so I might try, if we've got time, to reconstruct the theory of change in the way that I would see the activities running. But let's just try and dig in here a little bit into some of the elements. So if you zoom in a little here, you can see that there are a number of activities. These activities are shown over here in the text. I better change the color of the pen to something that you can see. So the activities are all listed along this line here. And the activities are really in just two major groups, two categories. Firstly, we have 4 activities that are part of component 1 of the project, and then 1 activity in component 2 and 1 activity in component 3. These 4 activities for part of component 1 are all around what I would say is establishing the fund. So there's an output of establishing the fund to create it over here. Fundraising, building on the pipeline that they've already got, screening new target markets. Then the investments that the fund itself makes. So following on from that fundraising, there is an activity that invests in local agribusinesses. This is going to be important. There are three types of agribusiness that's going to be invested in. You can see them mentioned over here. Firstly, the aggregator platforms. Secondly, digital platforms. And thirdly, innovative financial services. Once the investments have taken place as equity, so there's investment in companies to help build them, early stage companies and venture and growth companies, there will be post-investment management of the project, of the investment, of course, of the project to maximize the leverage of capital and to manage the exit when the acumen with the fund that is being created will exit from that investment. And then finally, there's a small activity around monitoring the portfolio to learn what is happening and to measure the impact of the project. So those four activities are all part of the equity. And then there is an activity 2.1, which is around technical assistance. And so to go with the equity is technical assistance funding. So there is a matching to support a number of types of activities. I'll give you a little bit of detail now. And the final activity in the project is around partnering with co-investors and stakeholders to amplify the impact, as they say. Now, GCF projects theory of change is always a little confusing because there's arrows all over the place. You can see a bunch of arrows pointing from each of these activities to all different outputs. But it seems to me that this is around establishing the fund. This is about this one, and this one are about operating the fund, which results in an output of companies expanding and improving their offering. So that sort of element. And the result of this output is that companies grow and increase their sustainability. So there's a path in a way from here to here. Maybe we'll try and redraw it on a later slide. Between these three outputs leading one onto the next, as it were. So that's useful, I think. There are a number of elements that I find also a little problematic with GCF's format for a theory of change, because yes, you don't see this progression from output to output, exactly how these connect. You can see arrows seem to connect everything to everything. So at least all of these outcomes and co-benefits all lead from these three, which is logical. You're going to establish the fund. You're going to start investing in companies, in agribusinesses, and then you're going to ensure that they grow, post-investment monitoring and leveraging capital and managing exits. So those three activities are delivering these three outputs. Yeah. And these outputs are resulting in improved farmer access to markets. And I think it's quite important is that there are three different stages there. There is the fund. The fund is investing in pretty large agribusiness, and those agribusinesses of different types are going to support these benefits: improved farmer access to products and markets. There's a co-benefit of female farmers, increased farmer resilience and adaptive capacity. Where does that come from? Where does that resilience come from? That's a question that I think was behind the request from one of the board members when this was discussed. All right, let's dig a little bit into some of those elements there. I said this is an investment fund. It's the ARAF 2 investment fund. The important thing about the 2 is that this is the second step, the second phase of the project. We'll focus on making equity and what's called quasi-equity investments. Quasi-equity investments can take many different forms, but for example, it could be something around a sort of convertible debt or something like that, where there is initially a loan that is given, and that loan gets converted into equity at a certain stage. So there's that type of instrument. And they expect to invest in 18 to 20 companies. So it's definitely a private sector. They're investing in companies, not in farmers, across East Africa, West Africa, and North Africa. At the time the proposal was approved, the accredited entity had approval from not all of these. From Cote d'Ivoire, they had a letter of no objection. There was a letter of no objection from Nigeria. They had it from Ghana. They had it from Egypt. And they had it from, I've said Cote d'Ivoire already, Egypt, Ghana, Morocco as well. They did not manage to get the letters of no objection from Kenya, they had it from Uganda, my apologies, yes, and from Tanzania. So there were two missing in that overall picture. And they also intend to expand to Ethiopia and Senegal. So there were, in fact, 4 letters of no objection that were not received by the time the project was approved. There's an interesting sentence in the proposal that says we hope to expand the project into those other countries, I guess, as they get the letters of no objection. So this is, for a private sector company looking to invest, this is an interesting approach. The investment approach is to invest in venture, that's startup businesses, early growth, when the business is already established and starting to grow. Also in growth stage investments, and with investment sizes between $500,000 and $6 million, with an option. So there's an option to increase their investment, depending on success, up to $12 million. All right. The Green Climate Fund is decided to invest $34 million into the fund as equity, in the form of equity, from $30 million, and $4 million as grants. So the investment was $30 million equity, $4 million grant. And the project plan is to attract other investors from foundations, financial institutions, family offices, private institutions, to the tune of $90 million for equity, and $8 million in the form of grants. So you can imagine foundations, family offices are going to be predominantly in the grant element, and the equity element is going to be predominantly from financial institutions, perhaps private institutions as well, although we have to wait and see what actually happens from that. All right, so what is the investment process? It's typical. For those of you that come from the banking sector, you won't find any of this different. There are 7 key steps. The proposal actually puts, you'll have seen, these 2 into activity 1.3 and these ones into activity 1.2. Yeah? And if I head back here quickly, these, in terms of these are funds, and establishing the fund is in activity 1.1, including securing additional funds. So this is the plan for the investment process: due diligence, investment note. There'll be a committee that will be investment committee. That's what IC stands for. Approval, full due diligence, detailed full due diligence, then negotiate and closing. Post-investment support and management. As equity investors, they will often have someone on the board of the company that they're investing in to steer it, to support it, to understand how that is developing, because the funds that flow back to the overall fund that they're creating, the money that flows back, is a result of meeting certain criteria before the funds. Like there's a hurdle rate and a carry, which is around the percentage of profit that flows back into the fund. That's how an equity fund is operating. I said there's a technical assistance facility also created. It's climate adaptation interventions that it will support. including gender-specific initiatives. And you'll have seen, if you watched the board meeting or you were there, that the gender aspects of this project were recognized by many of the board members along the way. And there'll be training for farmers, resilient practices. So this is where the project is actually working right there at the coal face of the small farms. They are doing this through their investments. They're not doing some different parallel training. The training is delivered through these agri-processing companies, as we said, 15 to 20 of them. There will be impact evaluation and measurement support. There was mentioned a few times that this is a third party. It is a third party, but it's notable that Acumen established this company. It's called 60 Decibels. If you've heard of it, I think you'll maybe have heard of it if you work in rural finance extension and such like. They are specialized in surveys and using modern tools for getting data on what's actually happening on the ground. So fascinating organization. If you're thinking about how to get good impact information and measurement support. And Acumen is a very minority shareholder, I think, in 60 Decibels. Then there are support for business development and management and ESG, auditing and legal support. It's going to work mostly in a cost-sharing way. What this means is that there is a certain amount of money, up to $50,000 for business development type of activities and ESG, and also up to $100,000 related to farmer training and gender initiatives. And it's important to know that the cost share does not apply to all of these types of activities. It does apply to business development and ESG, but not to the evaluation that's procured from a third party from the 60 Decibels, and the climate adaptation related to gender and training of farmers is not a cost share. In any case, the companies are expected to invest themselves first, and then they get reimbursed. So it's a type of play on performance. You get reimbursed for the cost share or the part that is being paid by the fund once all the deliverables are complete. And then there's a flow of funds. Interesting, but these are quite big companies, so they should have resources to cover things like 50,000 or 100,000 for the types of activities that they will do. All right, and then just to mention something about the types of projects. You saw it's ARAF2 that is being invested here. GCF already supported a project called ARAF1, which has, at the moment, at the time of submission of the proposal, a portfolio of $35.2 million US. I took this screenshot straight from the proposal. This is the investment into it, but the important thing that I want to note here is the types of investments that took place. And actually, the aggregator platforms in ARAF1 are covering all of this space, but there is some overlap. So you can see this area is pure aggregator platform. And over here we have blends between aggregator, digital and innovative financial solutions. And that's because of the way that an aggregator platform essentially works, where solutions are bundled together. So you might have the example given in the proposal is around outgrowers in Nigeria and an aggregator that makes tomato paste. So what do? They ensure that the farmers that they work with, the outgrowers who are actually farming, have access to seeds, have access to the inputs that they need for quality infrastructure, for irrigation and training. So the aggregator is providing those to the outgrowers that are producing the tomatoes for this aggregator. So that's the type of project that would be, for example, covering probably this aggregator platform over here, just pure aggregator platform. But it could well be that they offer financial services as well. But in RF1, only 2% of the portfolio was pure innovative financial services. Most of it's aggregator. All right. Thank you. And then just a quick overview of it. They want to make this whole fund amount up to 120 million. They call it a returnable fund. Basically, that money comes back. The equity is returned. Some of it to GCF, some of it to the others in this type of mix. 30 million from GCF as junior equity. That means it's at the highest level of risk. It could be lost. And 90 million in senior equity over a 10-year investment period. Yes, I think I've mentioned everything else that is here on this slide. So I wonder, do we have a little bit of time to build this theory of change? I just wanted to emphasize that, okay, my diagram is going, I'm doing it live, so I'm not exactly sure how good it'll be, but I'd like to emphasize that in thinking through a theory of changes, what do you do that produces the type of change that you want to see? So essentially, they're going to first create the fund, yeah? So they're going to create the fund. They're going to get investors from others into it, up to 90 million, yeah? And they've secured GCF funding of 30 million. So that's going to get fed into create the fund. The fund is then going to give loans. Who are they going to give loans to? So this is, the fund has to be created, has to do its process. It's going to give its loans a certain way. So this loans, I mean, it's going to make investments into companies. It's equity and quasi-equity. Yeah, and quasi-equity. Remember, quasi-equity, it could be convertible, for example. They'll make a loan initially and then convert it into equity, for example. And it's commonly used in the upfront venture type of activities. And they will make the investments. And who are they investing in? They're investing in aggregators. So I'm not sure if I can make a good picture of an aggregator. It looks a bit like a cat, doesn't it? But this is an aggregator. I should have mentioned that my spelling is not the best that there is, but they invest into aggregators or into single topic investments that will also be possible. For example, I mentioned the financial services. Okay, financial services there. And I have got the wrong slide. Okay, so they'll make those investments. What happens next? They will be invested. They will then invest in the companies and support them and manage them. And this, well, where does the technical assistance come from? Technical assistance might come over here. This is input from the technical assistance facility and input here from the technical assistance facility. Yeah. So there's money going in. And what this is post-investment investment. Yeah. So in a way, we've got a path there. Once we've created the fund, then we will make loans. When we're making loans into aggregators, then there will be this post-investment support, and there will be monitoring. Yeah. So this is impact monitoring. So these are the four activities that I talked about before. So there's these elements that build up here. Now, what actually happens? So where is the impact? How does this project have its impact? Well, they're investing over here in these aggregators or other types of companies, and those are providing services. So we've got a step that goes further beyond that to the farmers. Oh, I'm not going to draw farmers very well. We'll have to do with stickman. Maybe I should try for equality, which is very important to have a stick woman as well. They look exactly the same, right? So here we are. This is what we've got as the overall picture. And what do we have? Yes, so how do we see this as making an overall impact? These people are going to have improved resilience. And primarily, how will the improved resilience be delivered? This was one of the points that were asked in the board meeting. And it is primarily through what the Acumen, in responding to board comments, said was wealth accumulation. So it's producing a result. So this is the aggregators produce a result for improved resilience. Now, that's the sort of path of how it delivers. And we've got a technical assistance facility. So this one, I didn't put in the number there, but this one is a 12 million fund, 4 million from the GCF. This is 30 million from the GCF and 90 million from other investors. This is at the highest risk. So they will, GCF is the junior investor, will lose the money if they haven't received, if the company, for example, is not successful, they will lose the money first, and the other investors will lose it further down the line. So what that means is essentially that GCF gets repaid last if something goes wrong. That sort of idea. Okay, well, you can hear I could go on quite a lot about this, but if you're drawing a theory of change, I think a picture like this is a little bit more convincing for me. And the theory, where is the theory in this? The theory is actually embedded in this arrow, because it's that if we invest in aggregators, then we will produce improved resilience. I'm not saying there's a problem with the theory of change in this project. What I'm saying is that the theory of change, to be able to understand what actually is happening, where the change is, and where the assumptions are. Because if you head back onto, if I can get there quickly, if you head back onto the theory of change here, there are assumptions that are not necessarily all built in to the theory of change that I would imagine for the project, because you say ARAF invests in countries with a supportive policy and regulatory environment. I mean, that's sort of that's a precondition for the project. It's not an assumption, but I'm sure you can argue about that in different ways. So just a different type of perspective on it. When you draw out the theory of what we're actually thinking, in my opinion, it makes it significantly clearer. Now, I must apologize again for all the problems with the sound at the beginning. That means I've really run out of time, but I'm just going to talk about a couple of little issues that I see in the project. This slide, I think, is really interesting, bearing in mind the theory of change that I have just shown. Because for those of us developing GCF projects, the question is, where do the direct beneficiaries actually come from? If you look at GCF's definition of what a direct beneficiary is, it would actually be the way that we normally see it. So it's something, if you're developing a project like this, spend some time thinking about it. We normally see, oh my goodness, here we go. We normally see this as happening over here in terms of the direct beneficiaries being in this part of the project. I'm not going to draw on it because it keeps cutting out there. Maybe that's a sign that I should be quiet, see if there's any questions that anyone has along the way. And then bring the session to a close. What do you think about that? Does anyone have any questions? Please do ask questions. I can try and drill into some of these. If you need to step out, I think the video would be useful for you afterwards. If you need to step out, I understand that. If there are any live people in the chat, please do let me know if you have anything you'd like to cover. What I'll do while that's on is just ask you, before you leave, if you would be so kind as to follow this QR link, QR code link. This will lead you to a form which should take you even under 1 minute to complete, just to give your feedback about it. I'd really appreciate that. So please do that. But I'm still here if you have any questions, happy to answer anything that you might want to ask or any points that you might want to make.